This module of Veripax University is intended for those who own some form of investment property, perhaps a rental house or a commercial building. If you don't own investment property, then this module probably won't be very interesting. If you do own investment property, I'm making the assumption that you've at least heard of a 1031 exchange before. If that's not the case, then I would suggest meeting with either us or someone else who's familiar with 1031 exchanges to get a more in-depth education on the basics. We're going to talk specifically about how a Delaware statutory trust can be used in a 1031 exchange, and I'm assuming that most listeners don't know much about Delaware statutory trusts. This video and presentation is for informational purposes only, and nothing should be taken as investment advice. Let's start with a review of some basic 1031 stuff. We start with an investment property, and the IRS has specific rules about the definition of an investment property. Usually when we think of a 1031 exchange, we're thinking in terms of a rental house or maybe a commercial office building, but it can also include unimproved land or even a lease that has 30 years or more to go on it, although actually I've never run into that situation before. A lot of people will ask whether they can do a 1031 exchange on a vacation home. And if it truly is a vacation home, the answer is no. However, that doesn't mean that a vacation home can't be turned into an investment property or a rental. And if you have that situation, that probably merits a more in-depth discussion. So assuming you have a property that meets all of these, the definition of an investment property, then you can do a 1031 exchange, which involves selling the first property and then finding and purchasing a second property that's of the same or greater value if we want to avoid any taxes. The second property has to be like-kind property, but really the only definition of that is that it needs to be held for investment. So why do we want to do this? Well, it helps us to avoid capital gains taxes. So again, as long as that second property is the same or greater value, then we can do a sale and a purchase and we don't have to pay any capital gains taxes. So how does a 1031 exchange with a Delaware statutory trust differ from a conventional exchange? And from now on, we'll call these things DSTs. It's a little bit easier to say. In a conventional exchange, you take your investment property, you go buy a new investment property, maybe in a different state, or you think something that's better valued, and you do the exchange. Well, in 2004, the IRS said that property held inside of a Delaware statutory trust qualifies as like-kind property. So inside this trust is going to be institutional quality investments, maybe a couple of apartment buildings or an Amazon warehouse. So you can do an exchange into shares of a Delaware statutory trust. So it's like having your own personal real estate fund, and you can get much higher quality real estate with that. Professionally managed, income-producing assets, and you have no management responsibilities. 1031 exchanges kind of have their own language, so I thought I would go over some of the vocabulary just to make sure that we're all on the same page. The property that you would be selling is called the relinquished property, and once you've sold that, in order to be completely tax-free, you can't take any money from that. So if the escrow company ends up writing a check in your name, then the entire deal is off. So somebody else has to take that money, and that somebody else is what's called a qualified intermediary, or a QI. So the escrow company would wire the money to the QI, and then the qualified intermediary would fill out some paperwork and ultimately send those dollars on in order to purchase the replacement property. In some cases, you may want to take some cash out of this deal, or maybe the replacement properties, the values don't quite add up to what the relinquished property was sold for. And if there's any cash left over, it's what we call boot. And so boot is the taxable amount of this transaction. Boot can also be the amount of any debt that was paid off in this deal. So if you had a loan on that relinquished property and you don't have the same amount of debt on the replacement property, however much you reduce the debt by is also considered to be boot and is taxable. 1031 exchanges have some pretty well-known issues that can cause headaches. And a lot of these can be alleviated by using a DST. So let's take a look at some of these. Everything gets kicked off when you sell the property. That's what we consider day one of a 1031 timeline. Once you've sold that property, you now have 45 days to identify a replacement property and fill out some paperwork to let the IRS know what that property is going to be. So what happens if you just can't find a property? You also need to find a property or enough properties that will match or exceed your relinquished property value. Otherwise, you'll end up with some undesired boot that you have to pay taxes on. That can be a problem. Or you may not qualify for a loan anymore. Maybe when you bought that first property, you had higher income or bank situation changes and now the bank's not willing to extend your loan. Or perhaps one of the worst things that can happen is you get to day 43 or 44 and suddenly the offer falls out of escrow and now you're just stuck. So once a property has been identified, you now have 180 days from that day one in order to complete the sale or complete the purchase. What happens if the property doesn't close? Once it does close, you're now still have property management responsibility. And so that means the 4 T's of property ownership. You also, in order to avoid taxes, you have to either match or exceed the loan amount from your relinquished property, and sometimes that can be a hassle. So how does a DST help with all of this? Well, first of all, there's always multiple DSTs available at any given time. So there's never a problem finding a property and enough value in the property to match the relinquished property. So your exchange value can be matched exactly. You only have to buy as many shares as you absolutely need. The loan amount can also be matched, or in some cases you may want to actually apply a little more leverage. Whatever you need to do, because of these multiple DSTs, which typically have different loan amounts applied, we can mix and match DSTs to dial in the exact loan amount. But another key thing is that you don't have to qualify for the loan. The loans are qualified at the DST level. And then finally, one of the biggest benefits of having a DST is that you have no more property management responsibilities. Let's review some of the main advantages of a DST. And the first one is that you have no management responsibility. The sponsor of the DST is going to be responsible for all the property management, the upkeep of the asset, all the operations. You have no management responsibility. You also get a predictable and reliable income stream that's typically in the 5% to 6% range. When the sponsor puts together the DST, they're going to take a look at the expected cash flow that the property should generate. They'll give themselves some safety margin and then be able to distribute regular payments to investors. If the property ends up making more than those payments, then you might get an extra catch-up payment once in a while. In most cases, the DST sponsor makes their money off of the management of the property, not trying to get extra cash flow from the property. Also, as a shareholder, you get to continue to participate in the capital growth of that asset when it's ultimately sold someday. In a lot of cases, on a DST transaction, you're exchanging retail quality property for institutional quality properties. So it's very difficult for an individual to own a 300 or a 400 unit Class A hotel, for instance. Diversification is another advantage. In some cases, the DSTs might have multiple properties in multiple locations, so they're diversified themselves. Or you can invest in DSTs that have a single property, but maybe invest in multiple DSTs. Finally, the shares are easily transferable, so they're easy to gift to children or grandchildren. They're also easy to divide up in a will or a trust, so you don't have to worry about your heirs fighting over how to sell the property and how to divide the property. You can be in charge of the sale, and then DST shares are easily divided as part of a will or a trust. This all sounds pretty good so far, but there are some limitations of a DST. And the first one is that they tend to be illiquid for 5 to 10 years. In fact, most sponsors will set the expectation of 7 to 10 years. And during that time, the beneficiaries or the owners have no control over management decisions. So there's no asking members when it's time to sell or whether they need to do maintenance. All management decisions are made by the DST managers. There's also typically no secondary market for your DST shares. Sometimes sponsors will kind of create a market. If you have DST shares that you need to sell, they might advertise that fact to other members of the DST to see if somebody wants to buy them. But in general, you have to assume there's no secondary market. However, you can pass along your DST shares to heirs, or as we mentioned, you can gift them as well. Another limitation is that you can't reinvest the proceeds. And what that means is that if a property is sold and the proceeds are generated, then those have to go through another 1031 exchange if you want to avoid taxes. They can't simply be reinvested. Just kicks off a new 1031 exchange process. You also can't use capital expenditures for structural improvements. So as an example, you can't buy bare land and put up a building, or tear down an old building and put up a new building. There might be some improvements that you have to do that are required by law. You can maybe swap out appliances in an apartment unit or put in granite countertops, things like that, but you can't use money for structural improvements on a DST. You also can't raise new capital once the DST is closed. So you can't add new members, or you can't ask existing members for more money. And so if the DST runs out of its cash reserves, then repairs would have to come out of the cash flow of the property, which could eat into its profits. So most DSTs will set aside a cash reserve to handle those kinds of things, maintenance, upkeep, and plus an emergency reserve. Because of this limitation that new capital can't be raised once the DST is operational. There are really three primary reasons why people would consider using a DST as part of a 1031 exchange. And the first one is that they simply want out of the landlord business. They don't want to deal with renters anymore or getting calls in the middle of the night. And so this is a way to get out of being a landlord. The second one is to catch any undesired boot. So if you have a replacement property and that the value of the replacement property doesn't quite equal or exceed the value of the relinquishing property, but you don't want to pay taxes, then whatever spillover there is can be caught by the DST and you avoid paying taxes. And then finally, DSTs work great as a backup property. You have that 45-day window to identify a replacement property, and the IRS gives no leeway on that 45 days. So if you have a replacement property identified, but then something falls through on the deal on day 43 or 44, you can be in a real tough situation. The DST can be used as a backup then, so that you have somewhere for those proceeds to go and make sure that you don't get stuck paying taxes. To tie this all up, let's look at a quick timeline of a DST transaction. You'd start by putting your investment property on the market, and once you've identified a buyer and approximate close date, we would start selecting a qualified intermediary and start looking at the available DSTs to see what we wanted to purchase. The close of the sale of the property is what starts the time clock. So that's day one, and now we have 45 days to identify a replacement property and 180 days to close it. Shortly after the sale of the property, the funds will get transferred to the QI, and they'll begin completing the paperwork. One of the things that they're going to want to know is what's the address of the replacement property. In the case of a DST, it will be the address of the property or properties that are inside the DST. Once those have been identified and we've decided where we want the money to go, the QI will wire the funds to the sponsor or sponsors. And shortly after that, you'll get a notice that says you're now the proud owner of beneficial interests in the DSTs. So this whole process can be completed pretty quickly in an emergency. If we weren't planning on doing a DST and suddenly a property fell out of a deal at the last minute, DSTs have often been used to do a diving catch on a 1031 exchange, but it's obviously best to plan ahead. The sale of the property, the actual close of the sale of the property, is what starts the official timeline, and the exchanger who's doing the 1031 exchange must not receive the proceeds, or otherwise taxes will be due. Veripax Wealth Management is a fee-only advisor, so I wanted to give you an example of what a DST transaction would look like, at least in the way that we would handle it. It's a lot of numbers, but here we go. Let's assume that after all of the real estate commissions and everything, the net sale amount is $500,000 for your relinquishing property. And you have a mortgage balance of $100,000, so that means your proceeds are $400,000. That's how much is going to get wired to a DST company. But to avoid taxes, you have to match or exceed the existing mortgage balance, which means you have to purchase at least $500,000 worth of real estate. Now, that's not a problem in a DST because most DSTs have a loan associated with them. So they're actually going to own more property, and that will satisfy this issue of matching the mortgage balance. DST sponsors also pay advisor commissions. It's either 6% or 7% in some cases. I'm going to assume 6% for this example. And because we don't take that commission, that gets passed along to the client. That means that although you gave $400,000 to the DST company, you're actually get a purchase value of $425 and change, which is just a step up in 6% in value. Out of that $425, I'm going to assume that this DST pays 5% per year, so that would come out to be $21,276. Of that annual payment from the DST, $20,000 of that would go to you as the client. So that's 5% based on the original amount of $400,000. The other $1,276 gets paid to Veripax as an advisor fee, which works out to be 0.3%. So let's just highlight some of the key points here. And the first one is that the new purchase must have the same amount of leverage or the same mortgage amount as the previous loan to value. And again, that's no problem with a DST. In our case, the client gets an immediate step up in share value because the advisor commission is passed along to the client. So if it's a 6% commission, there's a 6% step up. If it's a 7%, you get a 7% step up. In the case of a 6% step up and our fee of 0.3%, it works out to be that the client receives the full payment from the DST based on the original investment amount. So you put in $400,000, they pay 5%, you get a $20,000 a year payment. And then for us as the advisor, we would get paid by the DST from the income that's generated from that step-up amount, that additional $25,000 in value that you received. Whatever income is generated from that step-up in value is what we would receive as an advisor fee. Hopefully that clarified what a DST does and why it's beneficial. Thank you very much for listening.